All right, ladies and gentlemen, my name is Andrew Stotts from the Valuation Master Class, and we're going to get another master class listening to one of our students who is doing their final presentation. Her name is Charvi, and the company is Samsung. Are you ready? Do you own Samsung? Are you thinking about owning it? Are you thinking about selling it? I suggest that you listen in today to try to figure out what to do with it. Charvi, how are you? Are you ready to go?
Yes, I am.
That's good. And are you nice and relaxed?
Yes, very relaxed.
That's good. All right. So let's get into it. I'm going to share your screen for a second and basically for the audience out there, if you've got questions, feel free to ask those questions while she's presenting, and then we'll go through those questions at the end. I'm going to remove myself from this as you start speaking, and then you just take it away. Are you ready?
Yes, I am.
Okay, so I'm going to remove myself now, and then you just start. I'm removing myself now.
Okay. Hi, my name is Chavi, and I will be presenting my research on Samsung Electronics, once a dominant company, but now seems challenged. I initiate coverage on Samsung with a hold recommendation based on a target price of 57,686.80 Korean won, implying a downside of 6.2%. I derive my target price from a DCF-based valuation using a cost of equity of 9% and a terminal growth rate of 1. My primary reasons for the hold recommendation include low growth prospects in the consumer electronics market, which forms just under half of Samsung's revenue. Samsung is losing its grip in the semiconductor market, and their heavy cost-cutting plans to boost profitability is likely to worsen their competitive edge in the long run. Some additional risks I see are failure to innovate amidst rising competition, higher semiconductor price volatility, and high talent drain, especially currently given the complaints regarding Samsung's working conditions and geopolitical tensions which could hinder growth. To provide some background, Samsung Electronics is a South Korean major appliance and consumer electronics company that generates most of its revenue from smartphones and memory. They have a 20% market share in the smartphone industry, its largest revenue driver, and constantly competes with Apple for first place. Samsung has a 7.5% market share in the semiconductor market, which is the second largest revenue driver and places second behind Intel. So my three key reasons for providing a hold recommendation are, firstly, the global consumer electronics market is quite heavily saturated, which can be seen as it has only grown by 6% over the past 5 years, and it's expected to continue growing at a similar slow pace. On top of this, Samsung has been losing market share to Chinese competitors, with its market share dropping from 32% in 2013 to 20% in 2022. Samsung's growth has historically relied on strong distribution channels and innovation. However, with new competitors entering, I forecast SG&A to rise as higher advertising costs and R&D to fund higher innovation will be required to further avoid losing significant market share, and this is likely to squeeze profit margins. Secondly, I believe currently Samsung has fallen slightly behind in the semiconductor market. Whilst the market remains very strong and is expected to grow at a CAGR of 11.6%, Samsung's manufacturing has underperformed compared to competitors, and this has driven down its net profit from 54 trillion to 14 trillion Korean won, the lowest net profit in the last 15 years. While Samsung leads in DRAM memory, they lagged behind in HBM performance due to heat and power issues. Samsung's semiconductor sales have strongly rebounded in the first half of 2024 due to rising prices and a strong surge in demand. However, I expect this recovery to be short-lived. Chinese firms have made up 30% of Samsung's semiconductor revenue in 2024 because they stockpiled on HBM semiconductors ahead of anticipated US export controls on China. As these curbs likely restrict HBM access, I expect a drop in semiconductor revenue in 2025 and lower sales growth in the years after that. And thirdly, Samsung has some cost-cutting plans which I expect to boost gross profit and EBIT margins. However, for example, they plan to lay off 30% of its overseas workforce due to its underperforming chip segment. However, some methods could potentially worsen their competitive advantage. For example, Samsung is increasing reliance on outsourced production, which gives Samsung less control over this, and this raises concerns regarding innovation and product quality, which could hurt their market share further in the long term. Moving on to Samsung's quarterly data, there's been a large year-on-year increase in revenue and an outstanding year-on-year increase in EBIT and net profit margins. However, this is due to Q2 of 2023 having one of the weakest revenues due to a strong drop in semiconductor prices. And this year, Chinese companies have been stockpiling, which has increased revenue quite strongly. And this contrast in events has resulted in such strange numbers. The growth constraints to Samsung are fairly high. Samsung accommodates for the capital-intensive nature of the industry well by ensuring high liquidity, and additionally, their diverse product range and vast distribution channels and highly efficient supply chain make capital and operations only a neutral constraint to growth. However, market saturation and rising competitors combined with difficulty in recruiting and retaining top talent increases constraints to growth, and these are both factors that Samsung has really been struggling with at the moment. To provide a brief breakdown of Samsung's revenue, 42% comes from smartphones and relevant accessories, while 70% of revenue comes from memory, so semiconductors and chips, etc. The rest comes from TV display screens, and home appliances, so the company has a very diverse product base. Due to their strong distribution channels, they generate revenue primarily from America, Europe, Korea, and China. And most of Samsung's phone production is based in Vietnam, while their semiconductor and display manufacturing is mainly in South Korea. Compared to 1,150 non-financial companies, Samsung is ranked 8th compared to its peers, based on fundamentals, valuation, momentum, and risk. This is largely due to the worsening data in 2023 and the past 12 months. We can see that margins, ROE, ROA have all worsened. Also, price to earnings have gone up quite significantly. Revenue growth and recurring EPS growth have been weak. Net debt to equity has been reduced and beta has increased. According to Porter's 5 Forces, I think Samsung has an average ranking. Rivalry among competitors is ranked just below average because there are many competitors within all of the segments Samsung operates in. However, only a few are roughly equal in size. Also, the consumer electronics is a slow growth industry, but this is partially offset by the fast growth in semiconductors. Whilst there are some technological disruptions going on, Samsung is part of this, so it shouldn't negatively affect them too much. Samsung has quite strong bargaining power against suppliers due to its strong control over most of its supply chain and their strongly diversified supplier base, which makes switching suppliers easier. However, the company's ability to backward integrate further than they already have is what has brought down the bargaining power against suppliers rating, as this would be quite difficult for Samsung to do. Bargaining powers against customers, contrarily, is quite low, as customers have many alternatives due to high competition, which allows customers to put pressure on supplying companies such as Samsung. Additionally, while Samsung has reasonably high-quality products and some brand loyalty, I believe customers are currently averagely price-sensitive. However, with increasing reliance on external outsourcing, this could increase price sensitivity further. The threat of new entrants is quite high, which can be seen by the significant rise in new startups, and this is because there is cheap and easy access to raw materials. However, recruiting top talent may be slightly more difficult. Achieving economies of scale to match Samsung costs would also be very difficult, which reduces the threat of new entrants in the long term. The threat of new substitutes is higher due to low switching costs for consumers, little perceived difference in products other than quality, and companies who are specializing in one segment could find ways to leapfrog Samsung's current business model. Samsung's ownership looks quite good, as 60% are independent directors, which is greater than the South Korean average of 56%. And this is a good sign, as they can hold management accountable and bring in diverse experience and expertise. Looking at the WCV, overall profitable growth has ranked average in the past 12 months, and this has mainly been dragged down by growth, which has been impacted mainly by expense direction. However, Samsung is currently working to try and improve this. Overall, the ESG score is pretty good. However, this is also because the company has established policies to align with ESG goals, which has improved their score. But it is worth noting that the practical implementation of some of these policies are questionable. So, for example, they have policies to operate sustainably, but they have been accused of greenwashing and releasing toxic substances into Vietnam, affecting local communities. Additionally, the vice chairman has been at the center of several high-profile bribery cases, corruption scandals, and even stock manipulation. So moving on to revenue, in 2023, EBT reached its lowest level since 2008 due to falling chip prices, higher production costs, and increased SG&A from semiconductor R&D. Due to strong stockpiling from Chinese companies, demand and prices have both gone up, so I forecast a strong recovery for 2024. However, this is likely to mean lower demand and therefore prices in 2025. My future growth forecast remains cautiously optimistic considering consumer electronics market maturity, the rising competition, but also the high growth potential in the semiconductor market. I expect cash to continue decreasing due to lower net profit margins compared to previous years, combined with similar levels of high capex spending. I predict inventory conversion days to decrease as the company is cutting semiconductor production due to oversupply, and any cancelled orders in 2023 due to other companies having too much inventory is likely to increase too, which would help Samsung push some more of its inventory out compared to 2023. As the company has not been prioritizing inventory management as such to reduce inventory conversion days, I predict a steady increase in inventory conversion days from 2025 onwards, reflecting the trend in the past. I expect cash to continue decreasing due to lower net profits. Long-term liabilities had a decreasing trend over the last 3 years. However, due to large expansion plans combined with lower revenue growth, reducing cash reserves, I believe their long-term debt and total liabilities will need to increase. Inventory days reducing is the main reason for my positive forecast for net working capital and why my net working capital forecast deviates from the previous years. CapEx increasing quite significantly in 2023 due to aggressive investments in semiconductors. However, as the company is focusing on cost cutting, I expect slightly lower CapEx. The ratios are either similar to previous values or hopefully have been justified based on my previous explanations in my slides, so I'm going to skip past these for now. I forecasted a 25% tax rate in 2027 and 2028 as the company has some tax payables, but I expect this to be paid off when their net profit returns back to normal. On the forward 2024 PB multiple, Samsung Electronics looks cheap compared to the infotech sector in Korea, Asia ex-Japan, and globally. I forecast its return on equity to be around 5.6% in 2024, lower than the sector average in Asia ex-Japan and Korea, and the world. This results in Samsung Electronics trading at a significant premium based on 2024 PB to ROE multiple, relative to its Korean and Asian peers. When using the 2024 expected PEG ratio, the company looks expensive relative to its Asian and Korean peers as well. I assume a risk-free rate of 4% and a market equity risk premium for the Korean market of 5%. Samsung Electronics has been a high beta stock, so I assume a beta value of 1, which is at par with the previous averages. I forecast a capital structure with around 8% debt to total capital, and this results in a cost of equity and a discount rate of 9%. I use a terminal growth rate of 1 and free cash flow to equity to value Samsung Electronics. And the other two markets highlighted previously include high semiconductor market volatility due to fluctuations in demand, and this could be caused by technological trends and economic conditions. And secondly, talent drain since companies and new startups compete for top talent. Thank you.
Excellent. All right. So let's go to your ratios page. Let's take a look at that. I'm going to ask you some questions, and then I think we got some questions that have come in. So if you can go up to ratios. Did you move your slide up, or is it just not showing on my screen? All right, let's talk. So let's go through some questions. You hear me, right? Hold on. Hopefully you're hearing me. Testing. 1, 2, 3. You hear me? All right. It seems like you can't hear me. So I'm going to end the presentation. We did get some good questions here, but for some reason, we're not getting a response. So I want to thank everybody for listening. And if you want to learn how to value companies like this, then consider joining Valuation Master Class Bootcamp and build a competitive advantage